Samir Arora, fund manager and founder with Helios Capital, joins us. Samir, good morning. Great to have you back. Samir, what should we now look forward to? Earnings season is over, budget adjustment is behind us, and today we'll hear from RBI. So what's next?
Preparing for World Cup, preparing for plans in general, but I think it's a period where you lie low in some sense, being a bit defensive and waiting for the outcome of the election. It is nice to say that elections don't matter or outcomes don't matter, but that is if you are straight away talking in 2 or 3 year kind of period. But if you say 6-month period, you may have a big fall in the month of May if something goes really wrong, or you may gain 5-10%. So since we are a fund and mostly always invested around our average, we have less to worry. But for a new investor, he may continue, of course, with his SIPs and otherwise and not sell, but there's no need to make big commitments at this stage.
The USP of Indian market always has been that you got good businesses, expensive, but great in terms of corporate governance standard. But when you hear what Vedanta has done, when you get shocked and surprised by what the jubilant promoters were trying to attempt on the royalty issue, suddenly markets have discovered that the SL group of companies have a large hole. How do you think foreigners would view that?
Well, the thing is that foreigners would view that is difficult to say because, unless you are directly a fund manager, the others don't get to hear of it. It's not that I go and tell the world how somebody's leverage or not. Either I'm long or short, and I will try and present it accordingly with some logic on that stock. But in general, the penalty of poor corporate governance has become very high. And if people still don't want to learn that, it is at their own peril. So that is very clear from example after example that it is not worth it either for the corporate to try and make small amounts of money, and also for the investor to not look at every corporate governance and a bad corporate governance and then say 5% later that now it is discounted. I think one reason why we have poor corporate governance is because the fund managers in India don't get angry publicly, and I don't know about privately. But in my times, I used to be publicly angry when I was a mutual fund manager. I think people have become too diplomatic, at least publicly. And that is why they, in a sense, mislead the masses by, not commenting or not strongly commenting on such things.
Okay, Samir, tell us, how are you celebrating the Chinese New Year? Fun, frolic, festivities?
Chinese New Year is now over.
Okay, acha.
This is the year of the pig.
Yeah. You're not born in the pig year, are you?
I was not. I think I forget, but I think I was ox or something, which is why I'm a bull.
Once a bull, always a bull, is it? Samir, just a coincidence? Samir, just a coincidence that यहाँ पे भी stock market, यहाँ पे भी bull की बात करेंगे.
पीछे भी bull, वो भी red color का.
But I'm an oxen or whatever. So pig year, as every 12 years, every of these are 12 years. So if you look back, 2007 was a great year for Indian markets. 1983 was a year of the pig in which we won the World Cup. And therefore, this time we have both chances. We can win the World Cup and have a bull run.
Share to that. I hope both happen. So we're seeing you in London in July, clearly.
In June.
June.
No, yeah. It is in June and July. But it's easier to plan for June. July, it's difficult to plan. Although
who knows where we finish. But hopefully, June and July both. Let's keep our fingers crossed. But tell me, Samir, it's not all fun and frolic for the market. I know part of the business, so we are celebrating 11K, the fact that we're just so close to that all-time high. But again, there is that misstart feeling. Again, it's those 4-5 names which are holding the Nifty up, broader market still languishing. Do you think this disconnect will continue for some more time to come?
This disconnect has been very painful for everybody, including us, because it's only 4-5 stocks that are doing well. And that's why I said right now, even though it doesn't feel, by the way, high or whatever, because of the fact that the broad market is doing so badly. And I think that is because of elections or whatever, because India is seriously underperforming emerging markets and Asian emerging markets. And the money that we are getting, I don't think we are getting money because they want to invest in sort of India per se right now. It is from a global emerging market ETF kind flow that we are getting a proportionate flow. And therefore it's very concentrated in the top names because that is how the MSCI index is. So we have to wait our time. That's what I was saying, that, we will change on the margin, stocks here, stocks there, but basically we have to get this event out of the way. That is the elections.
Right, but there's an event later today as well, which is the RBI credit policy, and while a very small fraction believes that they can surprise the market with a 50 basis points cut, the tone is likely to be dovish and supportive of growth.
Well, that I think the tone is given, because if we have gone through all this trouble of changing the RBI governor, it can't be for continuing the old system. So something has to change. But I would just think that it would not be very positive. I would be happy for a few days, but I think then we can easily build a case that this might affect the rupee, and that how will we in future read the minutes of the MPC if from a tightening stance you can directly cut rates in the next meeting and not even go through a neutral stance. And more than that, it would look everything as being done for politics and stuff like that. So I think they shouldn't do it, but they should obviously give the right signals, because India does need lower rates, and maybe a little bit is justified. But it's just that you have to do it with some decorum and with some process in mind, and not shoot off the thing just because now there's a new management in town.
When the IL&FS problem happened, it was an eye-opener for the entire NBFC sector that how bad their asset liability mismatches were. The so-called NBFC bull run got pricked. Now there are problems which are emerging in Diwan housing. There is a serious challenge as to how ADA group will be able to take care of their debt obligations or all their loans, because RCOM has gone bankrupt and we don't know which way that deal is headed. Are you of the view that there is another round of serious unwinding which could start in the entire NBFC stroke some of the banking stocks?
It is possible, and therefore we've also backed off from NBFC. Net exposure for us now, if we just leave out Bajaj Finance, would be negative, net. Because of legacy issues, endowment issues, in the sense that we had two old NBFCs on the long side other than Bajaj Finance. And we say, oh, this one is okay and that one is okay, this one has this angle, this one doesn't need money from the markets, but they are still part of the same broad category of NBFCs. So just psychologically, instead of selling those, we just shorted three other names and in a slightly larger amount. But I agree with you, these things can happen. We have seen consequence of related issues where one leads to another. And maybe that is the reason why the tech sector is doing well, for an additional reason, which is that people feel it is, first of all, corporate governance is okay and it's not connected to India. They don't have leverage, they don't have pledged shares and stuff like that. And that's a valid thing. So, these days, since I became a long short manager, and particularly after 8, I don't discount anything bad that can happen. I used to say that India is God's gift to stock market mankind. Now I don't say that. It depends on what happens, and we have to be ready for all situations.
Okay, in one of your comments you also said that financials are likely to do well this year. Which pocket of financials? Because if you break it down, the retail banks continue to perform, and that's a blind bet. Corporate banks, there's momentum there, but I don't know whether the best part of the performance is behind us. And then you have NBFCs where one needs to be a bit selective because the quality names have caught up, but there's a fair amount of pain still in the system.
You see, by the way, we would still be overweight financials in that sense, because some of the biggest stocks and the highest quality stocks are not even in the index. We are talking about MSCI index. So, for example, HDFC Bank and Kotak Bank are not even in the index. And for us, they would together be maybe 10-15% of our portfolio. So, therefore, by definition, we are always overweight because of the way the index is including these companies. But in a big picture sense or small picture sense, just because a company is well known does not mean that it will not do well or that we should be embarrassed. Sometimes a new fund manager would come and deliberately search for a new name because he has to show to his investors or to your viewers that he has found something unique, something new, something which others were not following, something he's bought out of consensus, something which the whole world never realized, and he's discovered it, whereas the best performing stocks have been these two banks. So in general, I would say we are overweight financials, and that includes private sector banks, and that includes the new corporate bank. New means the new trades, the new purchases, plus insurance, which hasn't done well, but which we think has a lot of tailwind. And we, as I said, we still own a big NBFC. And also in a thematic big picture sense, the India's and world's biggest sectors are always, financials, consumer, and tech, sometimes here or there. And so these 3 or 4 themes are all the themes that we will always play. We don't want to play value in state-owned banks. We don't want to play value in sugar and steel and commodities. We just don't want to play them at any point of their life or our life. So therefore, we will have to rotate within these 3-4 longer-term themes. We include autos in consumer, at least most of the autos. And we can define and broaden the definition of consumer, but we don't want to buy other things at mostly any point of our life.
That's interesting that you say autos, because, many on the street are now really challenging as to how much autos can grow from here. There has been a significant decline, devolume growth that one has seen, and that's played out in the earnings as well. So have you been buying afresh now that these stocks have significantly come off their top? I mean, across the bandwagon, that is, be it a Maruti or an Eicher.
We don't have the two-wheelers, and we are short 1 or 2 of them. We are talking about basically we have Maruti and we have a tire company and we have one supplier. So I mean that, but I'm saying I was speaking in a bigger picture sense that when I say consumer, we define consumer as broadly defined. Whether I have currently auto, I do have. But I'm saying I meant that if you broaden the definition of consumer, then consumer, financials and IT, pharma are the only real sectors in India. Why do we need to buy companies which are dealing with government, where you've seen how many companies, basically every company that has done badly or has gone bankrupt in India either was doing an infrastructure project or had receivables from the government or had something in arbitration which they won but never got the money. You please tell me any other company in India which has done really badly. All the ones have something to do with an infrastructure project or a receivable from the government because it had an infrastructure project. Either the road was not completed, or they didn't get the toll, or the toll was cancelled, or they went into arbitration. And nearly every company in India that has done badly, including ILFS, including SL, all are related to infra. Now we can learn our lesson, or we can say now there is value. We say, what is the point of analyzing for such value?
One very pet theme for everybody was low-cost housing. By HFC companies, Indians will need more houses, housing demand will always remain high, government will focus on making more pakka makans for Indians, and HFC stocks were trading at levels and valuations which is hard to imagine. The big picture is still intact, but the business, the valuations and the stock prices have come cracking down. So I wonder what's going on there.
No, but there again, I agree, but there it has got affected more by the fact that for an HFC to make good money, you either need to play with the asset liability mismatch or you need to give money to developers for some part. Because to compete with a bank, to borrow from the wholesale market, you can't compete with them unless you do one of these two things or mostly both. And this could have sustained, but the NBFC liquidity issue has created issue for that. But at least it's not government related. The stocks were liquid and you had 35 chances to get out of these and none of them have gone bankrupt. But I was saying more in terms of infra and all. I think it is more serious than just the stock market issue. The fact is, which private guy will now go and fund a 20-year road or a 20-year power project or a 20-year coal mining project? Who will fund it and with what confidence? At least I will not buy any shares of any of these. In an NBFCs, there was a mix. Some of these NBFCs are wealth managers plus brokers plus they have ARCs plus they had NBFC plus they were lending to developers. And true that they have also gone into trouble. And as I said, we have them now, so we have them, but we have tried to hedge by some other stocks. But broadly, at least they didn't get affected by government policies. They got affected by another company having a problem because of government, not policy, but receivables, which is, say, ILFS. And that's spreading. But that kind of an accident we cannot totally avoid. We are talking right now big picture, but even in the good picture stocks, there will sometimes be problems for sure.
Boom and bust, they always happen. So Samir, closing questions. Where do you think the earnings bull market is still intact for next 2 to 3 years?
No, first of all, my theory is that in a stock market, whatever you say, the underlying earnings growth in general is more than 10, 12, 15%. That is because our GDP grows 7% in dollar terms these days, in rupee terms also, let's say it's 9, 10%, and the corporate sector which is listed is more services and manufacturing and all, which grows higher than agri. So therefore there's an underlying growth of 10, 12, 13, 14%, and then if you select some stocks better and don't select some PSUs which are losing market share, you can grow more. That is an underlying push or whatever to the stock market. Now these earnings sometimes will get delayed, sometimes will come early, the discounting of that will sometimes be early, sometimes be delayed, but this push is always there. So if the market doesn't grow for 2 years, it will give you all those returns in the third year. If it has grown in 1 year, it will not give you for 2 years, but you cannot argue with that. And it has always delivered. There is no reason for us to believe that that will not continue to happen in the medium term and short term, long term. But in the very short term, you might have a 10% loss or 8% loss in a month if something goes wrong. And then it looks bad, so you delay the thing a little bit. We are not delaying because we are still 60% net, but I was saying in general that you can't blindly say that nothing matters. These things matter in the short term. Long term, you can always say, you don't have to interview me, you can keep saying to everybody and you'll be right that in the long term equity is better than anything else, and I'm the biggest believer of that.
Right, and thanks for sending that message across once again to our viewers. Always a pleasure, Samir. Thanks very much for joining us this morning.